Okay, welcome. Real Estate Rundown, June 2024. Paula Boyson is here. I'm Daniel Jackson. I'm the host, and we're going to be talking about what is going on in real estate and mortgage lending lately. Um, I think we have some interesting stuff to go over today. First, we'll share a few different news articles and market stats, and we're going to be talking about scams and identity theft. This stuff is on the rise. I'm getting a lot of these from current customers where just the crazy stuff you get in the mail that makes it look like it's such a great deal. And then when you dig into the fine print, it's actually a scam or it's actually not to any benefit to you. So that brings us right to a topic of shopping for a mortgage and some of the tricks that lenders play to make their quotes look better than others, and how to spot those and make sure that you actually are getting the best deal. And should I pay points or no points goes right along with that topic too. So we're just gonna plow through. Anybody feel free to stop us and ask questions anytime. Paula, feel free to jump in anytime. And all right, first is just a couple of local market stats for here in Yuma. So there's fewer homes that are selling. Inventory is starting to build up. I have been watching this since I got to Yuma in 2007, and we had kind of a real estate boom going on in 2006. We had 1,800 homes that sold that year. And then it was a few years before we got back to that in 2011. But then my story every year since then has been, hey, we're selling more homes than back during the peak of the market before the real estate crash in 2008. And that was true every single year until 2022. Then we stopped selling more homes than the previous year and we started to see a decline. So last year with 2,352 home sales in Yuma County, that's the worst number we've seen since 2015. I thought it was interesting to look at this. If you break it down year by year, on here, you can see this little line here. The lowest one is 2024. We've sold fewer homes pretty much every single month this year than we did last year. And last year is the green line. And you can see last year we sold fewer homes every single month than we did in 2022. So pretty much we've been on this decline where we're just selling fewer and fewer homes. Now, the other side of that is listings. So the orange on this graph, and this goes month by month, just back since 2021. So, but you can see as the orange bars are taller than the blue, that means that we're adding more homes to the market than we're selling. And so inventory is starting to build. And that's been happening for the last, almost a year or so, 10, 11 months, where we have more listings added than sales. Now, you would expect with something like that home prices would drop, but this is what our average home price looks like in Yuma, where you can see there's been some ups and downs for sure, but over the last 18 months, it's been very flat. And then this is the chart. If you look at the data exactly the same, but for average sales price, it's very different. So there's fewer homes selling, but the home prices are continuing to go up. So you can see this year, the average home price is higher than every single month of last year. And, over the last few years, the home prices have just continued going up. Not drastically, but they are higher this year than they were last year and the year before. Now, mortgage rates, currently 6.99 is the 30-year fixed rate average, just under 7%. With the inflation news from yesterday and the Fed talking about what they're likely to do coming up, we're going to likely see rates dropping. I think we're going to see rates dropping over the next few months here. Last couple of days have been pretty good, but the average 30-year fix is right under 7% at the moment. And to put that in perspective, we ran the numbers, this is 54 years back to 1970. When you average out all the rates, the 54-year average is 7.76%. So we're well below that, for whatever that's worth. Okay, this was a news article that Redfin ran. I thought this was really interesting, where they said Gen Z is the most likely to rate housing affordability as their #1 election issue. So Gen Z, okay, voting age would be 18 to 26 if you're in Generation Z. So that's the younger generation. The interesting thing about it is that of these Gen Z, of people in that voting age, only 26% of them own a home. So housing affordability being a hot button issue is not too surprising when you think about, okay, they're getting to the age where they want to buy a house and it's the most unaffordable that it's been in a long time. So if you look at this, as you get older, okay, you have the millennials, the Gen Xers, the baby boomers. As the older you are, the less likely you are to rate housing affordability as the big issue. I mean, even in baby boomers, 80% said it's a big issue for them, but you can see that it's declining as you get older, which kind of makes sense. Another little chart I thought was interesting. Americans are spending big on dining out. As you look at grocery prices going up, so look at this, food away from home back in 1997 was 41% of the food budget, 59% for groceries or eating at home. Now that has flipped, and we have 53% of household budget is going to eating outside of the house and 47% for groceries, which I think is crazy when I look at my grocery bill and how much you spend on food at home. Yeah, eating out is just, it's almost the same price anyway. So I think a lot of people are feeling that. Okay. Identity theft. Paula, do you want to talk about this or do you want me to do it? Me, okay. All right, so wait, what did I do? I think I have jumped ahead. All right, so how does identity theft happen? I thought this was interesting. This came from a class recently where there's just lots of different ways that you can get your identity stolen. You have to be really careful of this. So they have the different phishing things. So they call it vishing, would be a voice phishing, smishing, email phishing. All these are types of fraudulent cybersecurity threats where they're reaching out to you to try to get you to give them either your password or some kind of personally identifying information where they can steal your identity. Dumpster diving is still a thing where they can just pull your info right out of the trash. Wireless hacking, fake lottery winnings, any kind of scam where somebody will call you and try to get you to give your personal information to them. They can make it seem like they already have it. Scary stuff. All right. Fake lottery winnings and jobs are just one way of committing this pre-texting, where they make up a story to try to gain your trust and then trick you and manipulate you into giving your information. So you just have to really be careful that you're dealing with people and companies that you trust and that you're not accidentally giving out information that could be used to steal your identity. So this is an ad. A customer sent me this the other day. This is one he got in the mail, and I just scanned it because I thought it was so fascinating. So he got this and he goes, "Hey, I got your letter, and let's do it." So I'm like, "What do you mean?" So he sent me this, and you can see on the front it says Nova Finance. It says Nova Financial Investment Corp. Now, in their defense, underneath the stamp, it does say Go Home Loans LLC is not affiliated with your current lender. But I mean, if you get this and right above your name, it says Nova and you did your loan with Nova, then you're going to think, oh, hey, Nova's sending me something. I'm going to open this. Also, it says over here, financial documents enclosed. I mean, it just makes it look like it's an official notice of some kind. And if you look at this envelope, it's one of those trifold things where you have to rip off the sides and you think, oh, maybe there's a check in there. You're not sure what it is, but you feel like you have to open this. Financial documents enclosed. And then once you open it up, once again, Nova Financial Investment Corp, right up in the top. It says it again, we're not affiliated with your current lender, but there's Nova again. And then when you look at the fine print, it says, notice your current mortgage loan may benefit from new Fannie Mae programs. I mean, that sounds official. What's a new Fannie Mae program? This may result in the ability to lower your payments. This program includes an introductory rate as low as 4.625. All right, that sounds pretty good. When the average rate right now is 7%, if they're saying they can get you 4.625, then you're going to be interested. And then new monthly payment, 30-year fixed loan, $1,850. That's much lower than this guy's monthly payment because this is a higher interest rate, or he's paying a higher interest rate, and then that $1,850 doesn't include the taxes and insurance, whereas his current payment does. So just little tricks where it makes it sound like it's official. Oh, I looked this up. If you look over on the right, this is the 1098-T, which is the form that your lender is going to send you, or the 1098 is the form your lender is going to send you to show you to report your mortgage interest at the end of the year. And this 2024 up at the top, it just makes it look like it's an official government form. So it's just very deceptive. When you dig into the fine print on the back of this, it says you have to have a minimum FICO score of 780, 50% LTV, 350,000 loan balance. So you'd have to have a house worth at least 700,000. You have to owe 350 on it. You have to have perfect credit. Not to mention, even it goes on, it says displayed rate and APR based on the first year. So this is a temporary buy down, and they're even calculating the APR just based on your first year rate, which is not an accurate way to calculate APR. So this whole thing is just very deceptive. You really have to watch out for these kind of things. It also says the 2-1 temporary buy down and the ability for the buy down to be split and funded by two parties, seller, lender, borrower, real estate agents. So this pretty much has to be a home purchase. So they're advertising it as a refi, but then they're saying you'd have to get the seller to cover the cost for you. So it's just not a deal that they could even feasibly deliver to anybody who calls on this type of ad. So be careful of these kind of things. And if you ever get one, something that you think sounds too good to be true, you have questions about it, then just take a picture of it and text it to me or send it in and let us look at it for you. We'd be happy to do that. Okay, I thought it would be interesting or important just to kind of break down where mortgage rates come from. So if you are shopping for a mortgage, the way that you figure out whether it's a good deal or not and who you work with and all of that, there's just a few things to watch out for. So the biggest thing, if you think about how banking works, okay, you deposit money into the bank, like in your checking or savings account, and then the bank takes that money and they loan it out to other people at a higher rate of interest, and that's how the banks make their money. That's a very simplified version of it. Now, on the mortgage side, a lot of times customers will come in and they'll feel like, hey, this is a loan between you and me. They'll meet with a loan officer and they just want to get the loan done on a handshake. And it's just a lot more complicated than that because of the different stages of the process. So when a consumer applies for a loan, the place they're getting the loan from is called the originator of the loan. The originator is the one that takes the application, collects all your documents, and usually takes the loan all the way through funding of the loan. Now, the next stage of the process is servicing. Like when you may start making your monthly payments, they're going to collect all of your taxes and insurance. They're going to pay your property taxes for you. They're going to pay your insurance for you. They're going to report your 1098 at the end of the year, collect your interest, and keep track of how much you're paying down your loan. So sometimes the originator and the servicer are the same. Like Nova can fund a loan and then you can make your payments to Nova. That is possible. You can go to Wells Fargo and get a loan at Wells Fargo, and then you'll continue making your payments there. That's all. I mean, that's just the originator and the servicer can be the same, but they can also be different. And lenders always have the option with mortgages to sell the servicing rights to other banks. And then you might think that, okay, well, Nova is giving me a 7% rate right now. They must be making a killing if they're earning 7%. Well, the servicing of the loan, when your mortgage loan is funded, there's two separate things that are created. You have the servicing and then you have the debt itself. Now, the debt itself, for the most part, ends up at Fannie Mae, Freddie Mac, and Ginnie Mae, which basically securitize and pool all the mortgages, and then they sell them on Wall Street. So you can actually invest in mortgage-backed securities, which are like bonds. You could invest your money in those that are backed and guaranteed by mortgages on houses in the United States. So that's kind of how it works. So what happens when we fund the loan is we give the debt part to Fannie Mae or Freddie Mac or Ginnie Mae, and then we get our money back so that we can continue funding the next loans. So we're not actually the ones who are collecting the interest over the long term. So now there's money that is earned at each stage of the process. There's, when we sell it to Fannie Mae, we get a servicing release premium. If we sell the servicing, then the servicer also pays a fee to the loan originator for doing all the upfront work. So each stage of the process has those. Now, the reason why that's important, I'm going to get into in just a minute. So one thing that happens a lot when you apply for something right now is you get all kinds of unsolicited phone calls from places. And that letter is probably one example of that, but we have customers who will pull their credit to pre-qualify them for a house, and then within 10 or 15 minutes, they'll start getting these spammy text messages, emails, and phone calls from other companies saying, hey, I see you're looking to get a mortgage. Guess what? We could get you a better deal. And so you start to wonder, well, could they get me a better deal? Am I getting the better deal? And I think pretty much anybody's going to want to shop for a mortgage right now. I think my own mother would shop me in this market that we're in because you want to make sure that you're getting the best possible deal. The thing you have to know is that the companies that are doing that are not ones that you have an established relationship with. They're marketing companies that are basically paying a fee to the credit bureaus to get access to your information. I think it should be illegal, but that's beside the point. They're getting access to your information and then they're using it to try to drum up business. So if you want to opt out of this kind of thing and keep companies from getting access to your information who have nothing to do with you, then you go to this website, optoutprescreen.com. You fill out the information. This is a government website. It's a safe place to put in your info, and you can safely opt out of getting these kind of pre-screened offers. It's pretty scary the amount of information that companies can get from the credit bureaus with no permissible purpose from you. You've never given them access to your information. You haven't applied for a loan with them, and yet they'll know how much debt you have, what your credit score is, whether you own or rent. I mean, just all kinds of personally identifying information. It's embarrassing. Okay, so when you're shopping for an interest rate, you should know that there's not just one rate any day. There's a lot of things that will factor into it. So over here on the right, this is our rate chart, the rate board that shows you the rates as low as 4.75, and it's kind of cut off here, but you can see it goes up all the way to 7%. So the rate that you get is going to be dependent on a lot of factors on your loan, like what your credit score is, how much money you're putting down, the type of loan you're doing, the type of property you're buying, and lots of factors like that. I think there's 26 or so factors that go into it that could make a difference in your rate. Like this is the chart from Fannie Mae right here that shows these loan level pricing adjustments that based on your loan to value ratio, so how much you're putting down, and your credit score, you can see there's going to be major differences in the rate depending on those two factors, and that's just two of them. Now, so then on this chart, what we do is what our goal is as your lender is to put the deal together so that you're comfortable with the monthly payment and you're comfortable with the amount of money you're coming out of pocket with. So you can see on this chart, it shows if you take a rate of 7%, there's going to be a credit of $2,100 that's generated that will go back to you to cover your closing costs. Or if you want the rate with no points, on this day, it was basically 6.5%. And then you could get a rate all the way. Now it's cut off, so I can't see what these rates are, but you can get a lower rate by paying higher closing costs over here on the right. So that's called paying points, and we'll talk about that in a minute. Now, when you're comparing quotes from different lenders and shopping around, there's 5 things that I see all the time that mortgage lenders will do to try to make their quote look better than other companies, even though it legitimately probably isn't. So one of those is, the first one is taxes and insurance. So when you're out getting pre-qualified and looking at houses, the property taxes are going to be different for every single house. And so unless you're getting a quote on one specific property that you're making an offer on, then we usually use estimated property taxes. And this can vary drastically depending on where you're buying a house. In some states and some counties, the property taxes are reassessed whenever the house sells. So it's going to be based on whatever you pay for the house, you're going to pay their property tax percent. It might be 1 or 1.25%. In Yuma County, what happens is the property taxes are not reassessed based on the sales price of the house. The county assessor does a market value analysis every year, and then they determine that. But it doesn't matter what the house sold for, it matters what they assess it at. And so you'll have the actual taxes on that house won't change from one owner to the next. But our average tax rate is about 0.79%. So what you do is you take your price you pay for the house times 0.79%, divide it by 12, and then that's going to be included in your monthly payment. So it's really easy. We'll have customers sometimes that'll say, hey, we got your quote and your rate's actually lower, but the other lender's given us a lower monthly payment. And it's either they're leaving the taxes and insurance out altogether. Sometimes they can lowball the taxes and insurance, and that makes their monthly payment fictitiously look better than it would at the other lender. So you just have to know, regardless of which bank you end up doing your loan with, the property taxes are going to be the same. And you get to choose your insurance company. So if they lowball you up front, it's terrible to be expecting a $1,200 payment and then have it end up being $1,300 or $1,400 because of the taxes and insurance being underestimated by the lender. So we never do that. We try to overestimate up front so that if you're surprised, it'll be a happy surprise. All right, the second thing is closing costs and points, which is kind of what I was just showing you, where you can pay extra points in order to get a lower interest rate. So a lot of times when you're shopping online for rates, the online lenders are going to quote you with points included in the rate. So right away, I mean, back to this chart from on the previous page, how do I do that? I mean, right away, if we say, hey, your rate's going to be 7%, and they tell you, hey, it's 6.5%, I mean, all the mortgage rates pretty much come from the same place. So the difference in those two rates is going to be the difference in paying the points or not paying the points. So What we do is when it's time to lock in your interest rate, we'll give you full access to the rate board and you get to choose whatever rate you want. But don't be fooled by that up front. Another one is third-party fee estimates. It's really easy just to underestimate and say, hey, the title company was only going to be $300 when really it might be $2,000. Underestimating fees that are not determined by the lender is a way that lenders make their quotes look better up front, but it might not be actual fees. So lock period is another one. A lot of people don't realize that the longer you lock in your interest rate, the more it costs. So when you're shopping rates online, a lot of times they will quote you on a 15-day lock period, and you might have a 45-day escrow when you're not actually closing until 45 or 60 days out. And so a 15-day lock is not going to be valid for your situation. So make sure that you're not being quoted a shorter lock term than you need. And the other one is prepaid interest. So for example, I have a client right now, we just got the contract, August 1st closing date. So when you close on your mortgage, you don't have a monthly payment until the first of the month with one full month after the fact. So if you close on August 1st, you're not going to have a payment until October 1st. And when you pay your payment on October 1st, you'll be paying all the interest that was accrued in September. So if you close August 1st, part of your closing cost is going to be all of the August interest, because you'll have to pay the August interest up front, and then the September interest will be paid when you make your first payment in October. So in this guy's case, $2,200 of prepaid interest is included in the closing costs. Now you might look at that and say, oh, hey, Nova's taking advantage of me. My closing costs are $2,200 more expensive here than they are at the other lender. Well, that's not the case. If the other lender's not showing you the prepaid interest up front like that, then most likely you're going to have a monthly payment that's a month earlier, and you could make your payment September 1st instead and then not collect the $2,200 of interest. So all those are just little subtle tricks that can be used to manipulate rate quotes, and you want to make sure not to be fooled by those things. And really, there's so much fine print in mortgage advertising and mortgage disclosures that you just want to make sure that you're dealing with somebody that you trust and not just some fly-by-night company off the internet. Okay, questions about that? I'm going to take a drink. So then the question comes, should I pay points or not? On that chart, you noticed that the higher the rate, the lower the closing costs. Well, here's how it looks in an actual example. 350,000 sales price, and I believe this was an FHA loan. So we looked at it and said, okay, if you pay no points, you're going to be a 7.25 interest rate. With your down payment and closing costs, you're going to need about $18,278, and your monthly payments $2,816. Now you could pay points, so paying 1 point would be 1% of your loan amount. So notice your closing cost goes from $18,000 to $21,000, and then your payment drops to $2,700. So you're saving $115 a month, and you're adding about $3,000 and $3,500 to the closing costs. You could go further and pay more points. At 1.75 points, you get 6.25 rate. You could pay 3 points and get 5.875. So which one's the better deal? It's hard to know. First off, if you're okay with paying $28,000 out of pocket, then you might consider putting more money towards your down payment versus putting it all towards loan fees to get a lower interest rate. And that would be a different discussion. If you're trying to keep your total dollars out of pocket as low as possible, then you a lot of times will want to go with the no points option. It's a little higher interest rate and a little higher monthly payment, but it saves you, in this example, it's over $10,000 out of pocket. So it's something to consider. What we do is we look at the total cost of each option over the life of the loan. And I don't mean over 30 years, I mean over the life of how long you're likely to keep that mortgage. In today's market, with interest rates being where they are, we think that you're not likely to keep this mortgage more than probably 2 years in the future. Of course, you have to make a deal that you can live with over the long run, because there's no guarantee you'll be able to refinance. But I think that the chances of rates being lower sometime in the next 12 to 24 months are pretty high. And so I like to run the analysis over 2 years. So the total cost analysis takes into account all that stuff: how much your monthly payment's going to be, how much of that will be going towards principal, how much you'll owe on the loan at the end of the 2-year period, how much you're paying in interest and mortgage insurance, and then of course the upfront extra closing costs and points that you're paying to come up with the total cost. And what you want to do is go with the loan that's going to cost you the least over the time that you're going to be in the property. So in this example, the 1.75 points wins out. It costs you $61,793. If you went and paid more points to get the 5.875 rate, you'd actually pay $63,477 over the 2 years. So the lowest rate is not always the best deal. And then here's a chart just so you can see it very easily. Okay, which one saves me the most? The 1.75 points comes out $1,600 ahead over paying more points. So anyway, there's a trade-off between how much you come out of pocket with and then how long you're going to keep the property, of course. And then we can run this for any amount of time. This is a 2-year analysis. Obviously, over the long run, a lower interest rate is going to save you more money. So the lowest interest rate always wins out in the long term, but it just depends on how long you're going to be in the house on whether or not that's worth it. So what we're doing right now is just monitoring interest rates. We know that all the loans that we closed for people probably all last year and all this year are going to end up being refinanced at some point in the future. And so we're monitoring that closely. We look for opportunities when the rates drop, then we're going to be proactively reaching out and offering the rate redo where we don't charge any lender fees. We try to put these deals together with zero money out of pocket and the same term as what you have now. So that means if you get a 30-year mortgage and it's 2 years before you refinance, then we can do the new loan at to a 28-year term so you're not adding to the term if you want to. Okay, and then we always have to run the numbers to figure out once it's time to refinance, is it worth it to refinance or not? And with that, the same exact chart on interest rates is going to come into play when it's time to do that. So for example, if you got a 7% rate and rates drop to 6.5%, you might think, okay, well, I'm going to take the 6.5, drop 0.5% off my interest rate. It saves me $183. But you're going to have closing costs. And so notice here, you're going from owing $156,618 to owing $160,000. So you're adding closing costs. So there's something called a no closing cost refi. And this is what we look for is opportunities where we can do no closing costs, where upfront your loan amount stays exactly the same. We're not adding anything to your loan balance. And then like right now, this is what we're running into is that we run these numbers and to get you the no closing cost refi, it's not really any rate savings. So in this case, you look at it and say, okay, well, we could do the no closing cost, but you'll end up with the same rate. So there's no point in doing that. So what we're going to be doing is monitoring the market and looking for a time when rates have dropped enough to where we can do the no closing cost refi and get you a lower interest rate. And then that's when you're really saving money. All right. I think that's all I have. Any questions? Paula, anything you want to add? All right. Okay. Well,
I
thanks
think you
for
did a
coming.
great job.
All right. Okay. Well, thanks. All right. Thanks for coming, and we will see you guys again next time.